Hello, my name is Jay Chauhan, and in this video, I want to describe to you how a shareholders agreement typically works in a small company in Ontario. And first thing I want to mention is that I have a sample agreement with me in which there are supposed to be three shareholders. In a typical small company, you may have one, two, or three shareholders, or four sometimes. So when you have two shareholders, it's easier to have what is called a buy-sell agreement, or what is commonly known as a shotgun agreement, in which you can say to the other shareholder that I'm giving you 30 days notice, and if you agree with the price, you buy me out. And if you don't agree or say something for 30 days, you acquire the right under the agreement to buy him out. This is how you solve the problem in a corporation, in a small corporation, because if you don't solve it and you try to look for a winding up in a company, you would have problems trying to wind up under the law, and you go to court and nobody in the shareholders in the as shareholders in the company want to do anything. Mostly it is the directors themselves who are shareholders in a small company. So you do not have any opportunity to rectify the problem once it's locked into the corporate procedure of the court system for winding up. So it's very important to try to create a shareholders agreement. But very briefly, what is in a shareholders agreement? Firstly, you don't want outsiders to be shareholders in the company, because if they do, you don't know them and you will not be able to deal with the arrangement of the decision making with the people that you know so easily and you're comfortable with. But usually, the important thing to keep in mind is that whoever the shareholders are, family members or friends or strangers, you have to allow some expression of the shareholders who are holding certain number of shares to be represented on the board of directors who run the company for a year after they're elected. So I think it's important to allow that to happen, even if the rules say that the majority will have the right to elect. So it's not necessarily the legalities, but your ability to manage the relationships, which is very important in the shareholders agreement. But in the typical agreement that I'm looking at, you have the first option. If you want to get more capital, you offer to the existing shareholders first if they like to subscribe for the new shares. And you have different layers of preferred shares that you can arrange. And in the current vocabulary, you can just name them whatever you want and whatever conditions you want to impose, and you can write them in the articles of the amendment and create the preferred shares who get the shares dividend first before the common shareholders share in the company's net profits through the dividend. So if you look at a typical agreement, you have an endorsement arrangement. So what are the conditions that sit in a shareholders agreement that you ought to know? Now, I think you can write on the back of the share certificate that the conditions that attach to the shareholding would be capable of being examined at the head office of the company. You can always get the articles of amendment from the ministry where the amendment was created. Now, coming back to the disagreement, if it is a unanimous shareholders agreement in the Ontario law, you can compel the parties to observe the terms of the shareholders agreement regardless of the bylaw says. So it's important to get unanimous agreement in a shareholding of a company, in a small company in Ontario. So should you have, I mentioned what happens in a two-person agreement. If you have three persons in a company or more, here's the challenge. The first shareholder says to the remaining two that if you want to buy me out, you too buy me out, otherwise I buy you two out. So it makes it more difficult financially when you are short of capital to try to buy more than one person on the other side. But that's one way to solve the problem of a disagreement in the company. Um, Suppose a shareholder dies, what do you do? If a shareholder dies in a company, the shares pursuant to the will of that person will end up with the spouse of that person, very often a wife who is not familiar with the business. So it's very difficult for the wife to manage the business when she has no experience, but that's what ends up happening. So you might have an arrangement in the shareholders agreement that the shares may be bought out by another shareholder who is active in the company, and that provision can be put in the shareholders agreement. So there are special provisions that you can write in the agreement that deals with the question of a person dying. If you have a pre-agreed resolution each year in the annual meeting that indicates the value of the shares, then you can compel the sale of the shares with that particular valuation and ask the estate to buy out the shares. If you don't have such agreement, it becomes difficult. You have to negotiate and find a resolution by amicable arrangement if you have not thought out and had an agreement in the company. So valuation of the shares each year when you have a shareholders agreement is important. That normally I put in 400 days to keep the valuation going until the next meeting, which would take place within a year, and you apply the valuation based on the revenue of the company or the market value of the shares, and then you can write that value and agree on it for the purpose of the parties dying or buying each other out. So these are some of the items that you can deal with in the shareholders agreement. I would suggest also that you put in the names of the shareholders who are currently there. If it is a unanimous shareholders agreement, then you know which people you have to deal with. So you do have a minute book of a company where the shareholders are listed, but when there is a unanimous shareholders agreement, it is agreement that really counts. So I normally write down the names of the parties who are shareholders. I hope that was useful, and if any questions, please let me know. If you'd like to join our group, it's called Angel Mentorship Group. We have presence in the Facebook and also my own website, J. Chauhan, in the LinkedIn, where there seems to be more people watching these videos. So I'm going to move more of my stuff to the LinkedIn. And recently I had a lot of responses for people who want to learn with us various areas of law. And I want to make it possible. So hope you're listening. And it's difficult for me to connect with everyone, but I will try. My name is Jay Chauhan, and I'm a mentor at Angel Mentorship Group. Thank you.